Hi, this is Jessica Dunn, and today we're going to discuss the term structure of interest rates. Time to maturity is the amount of time you have until the principal of the bond is paid off. So at that point, the borrowed money would have been repaid, all interest would cease, and the principal has been returned. So as the bond approaches maturity, the price of a premium bond is going to decline. The price of a discount bond is going to rise. So as we approach maturity, all bond prices are going to converge to par. So that bond that was trading at a premium is going to fall until it hits par value, and that bond that was trading at a discount is going to rise until it meets par value. And this is because the the factors that cause the bond to trade it at a discount or a premium are its coupon rate versus the market interest rate. If the coupon rate is less than the market interest rate, that bond is paying below market interest on its loan, so it would trade at a discount. If the coupon rate is higher than the market interest rate, it's paying more than is necessary, and it will trade at a premium. And as those coupon payments are made, they're having a much smaller effect on the price of that bond today. And so once you get close to maturity, the largest payment left is that par value. And so that's going to cause this bonds to converge to par. The real rate of interest is an interest rate that exists in a perfect world. So exists in a world where there is no inflation, where there is no liquidity preferences, so we don't care if we get our money today or tomorrow, and there is no risk. So the real rate of interest only fluctuates with economic conditions, tastes, and preferences. So it exists only in a made-up world. The nominal interest rate is the actual interest rate charged by the supplier and paid by the demander. It differs from this real theoretical interest rate because of inflation and risk. So if inflation exists, then investors demand a higher nominal rate of return. As risk increases, then investors demand higher interest rates as well. So here's an equation that shows us the relationship between the nominal interest rate and the risk-free interest rate. So here's the nominal interest rate. Here is this real rate of interest. Now, the real rate of interest differs from the nominal rate because of the inflation premium and the risk premium. Now, we do have a nice tool to measure the risk-free rate, which would be the real rate of interest plus the inflation premium. We can use Treasury Inflation Protected Securities, or TIPS, Treasury Inflation Protected Securities. So we could incorporate this real rate of interest plus the inflation premium as the risk-free rate of return. So we can say that the nominal interest rate is equal to the risk-free rate of return plus some compensation for the risk that you're bearing. So here's an example of how inflation matters. Marilyn has $10 that she can spend on candy. That candy costs 25 cents each. So today she could buy 40 pieces of candy. $10 divided by 25 cents is 40. The nominal rate of interest on a 1-year deposit is 7%, and inflation is 4%. So let's see how much candy she could buy in 1 year. So first up, she's going to have more money than she has today because she can earn 7% on her deposit. So in 1 year, she would have $10, her current deposit, times 1 plus 7%. So she would have $10.70 in 1 year. But the price of candy has also risen because we have inflation. We have inflation of 4%. So today, one piece of candy costs 25 cents. In 1 year, that price is going to rise by 4%, causing that candy to now cost 26 cents each. So as a result, she can, in 1 year, she would be able to buy 1070 divided by 26 cents, 41.2 pieces of candy. So that's really only a 3% increase in buying power, because this year she could buy 40, next year she could buy 41.2. So a 3% increase. That is the difference between the rate that she is earning, that nominal interest rate, and inflation. So the real rate of interest is her buying power increase is the real rate of return. She can buy 3% more if she waits 1 year. The term structure of interest rates is the relationship between maturity and rate of return with bonds of similar risk. So that's the important part. We're looking at different classifications. So we're not comparing an A-rated bond to a B-rated bond. We're looking at bonds that have the similar risk levels. A graphic depiction of the term structure of interest rates is the yield curve. Yield to maturity is our measure of rate of return, which was the rate of return you would earn if you purchased a bond and held it until maturity. So here is the yield curve, which is the graphical depiction of the term structure of interest rates. Yield to maturity is plotted on the vertical axis and time to maturity is on the horizontal. The position and the shape of the curve can change over time. A downward sloping occurs very infrequently, and it's often a sign that the economy is weakening. Most recessions are preceded with a downward sloping yield curve. Flat yield curve means that the rates aren't varying very much. A normal yield curve is upward sloping, as is seen by the orange line. That indicates that long-term interest rates are higher than short-term. The blue line would be the downward sloping or the inverted yield curve. Short-term rates would be higher than long-term. And the flat yield curve, the green line, shows us that interest rates are not changing very much. And we have some different theories as to why yield curves can take different shapes, and we're going to walk through those now, but keep in mind that they are theories. They have not been proven. So the expectations theory says that the yield curve is reflecting investor future expectations. So what do we think is going to happen tomorrow? So an upward sloping yield curve would mean that we expect interest rates to be increasing. Downward sloping yield curves would mean that we expect interest rates to be decreasing in the future. So an upward sloping, we expect interest rates to increase. Downward sloping, we expect it to decrease. A flat yield curve means that we don't expect there to be a lot of change. So if investors expect interest rates to rise, then the 2-year rate today must be higher than the 1-year rate today. So that would give us cause for an upward sloping yield curve. So here's an example. Let's consider an investor who purchases a 5-year note today. They plan to invest it into another 5-year note in the future. So they're looking for a 10-year investment horizon. In the first 5 years, they expect to earn about 3% per year. And the second 5 years, they expect to earn 2.5%. So they expect interest rates to fall. So that would be a collective return of about 27.5%. So to compete with that 3% for the first 5 years and 2.5% for the next 5 years, a 10-year bond today would offer 2.75% per year. So it would be less than the current 5-year, but higher than the expected future 5-year. So it's in the middle. So the 10-year bond would pay 2.75 because that still generates the same 27.5% return. Liquidity preference theory. This says that all else equal, investors prefer to buy short-term securities while issuers prefer to sell long-term securities. Short-term securities are attractive because they are very liquid and prices aren't very volatile. So because of this, investors will accept lower rates on short-term bonds because they are less risky and more liquid. So we prefer money now to later, and so we're always willing to receive less for short term than we would for long term because they are less risky. And so that only gives cause for the yield curve to be upward sloping. So liquidity preference says that long term rates are usually higher than short term, and so the yield curve should be upward sloping. Market segmentation theory, I think this makes the most sense to me. But this says that all sale of bonds is in a competition. So the person that is purchasing 5-year bonds, they're not looking at the price of 10-year bonds because that person knows that in 5 years I'm going to have this obligation and I need to have cash available for that. So they're not even looking at the 10-year bonds. The person that's looking at a 20-year bond isn't going to look at the price of a 5-year bond because they know that they need to have their money available in 20 years. So each different segment of the market, each different term, so the 5-year versus the 10-year versus the 30-year, are going to be decided independently. So the market for loans is going to be segmented based on maturity. Supply and demand for those loans will determine the interest rate. So upward sloping would indicate that there is greater demand for the short-term segment than there is for the long-term. And so because there's greater demand, that rate is going to fall. So there's fewer people who want to purchase long-term bonds, and so the issuer is going to have to pay a higher interest rate to entice them to purchase. So let's look some more at the determinants of market interest rates. So the required rate of return for debt is equal to this real rate of interest plus an inflation premium plus risk. And we can break that risk down into several different buckets. We can call it inflation. Well, we already talked about that one, sorry. We can talk about default risk, liquidity risk, maturity risk, where default risk is the possibility that the issuer is not going to pay the interest that they've promised. Liquidity risk, or liquidity premium, this is the premium that is charged by lenders to reflect that some securities cannot be converted to cash on short notice at a reasonable price. Maturity risk premium says that longer term bonds are exposed to a greater risk of price decline. And so lenders are going to charge more to cover themselves for this risk. So this nominal interest rate we said was equal to the real rate of interest plus an inflation premium plus the risk component. But we said that we can use the risk-free rate of return, or that rate on Treasury securities, to approximate for the real rate of interest plus inflation premium, because the Treasury securities are tied to inflation and they're a really good estimate of the real risk-free rate. So if we were to look at like Treasury bills, for example, a U.S. Treasury bill, a short-term one, the interest rate on that Treasury bill is going to be an accurate estimate of the risk-free rate. So we can substitute in that risk-free rate of return for the real rate of interest plus the inflation premium. So it makes our equation a little bit more manageable. We don't have to know what this real rate of interest is that exists only in a perfect world that we have no clue how to calculate. Instead, we can use the risk-free rate because that is, or the rate on Treasury securities, because they are inflation protected, and that gives us a really good estimate of the two. So the required rate of return on a debt security is equal to the risk-free rate of return, so the Treasury bill rate. Now you can use like the 3-month rate for that, plus risk. And we had already broken that down into the different buckets: default risk, liquidity, and maturity risk. So default risk is the likelihood of default. So the likelihood that the issuer is not going to repay interest and principal as promised. So with that, there's a greater default risk would mean that there would also be a higher yield to maturity. So the market price would be lower today, which would yield a higher return for the purchaser. There are different factors that help us to determine the risk premium. We could look at financial ratios, so we could look at their debt profitability or their current ratio. We can look at different provisions within the contract, so whether the bond is secured or unsecured, whether it's senior or subordinated. So if it's secured, that means that there are assets that are tied to this bond issue. So in the event that they don't pay the bond obligations as promised, then the bond holders could seize assets. If it's senior or subordinated, senior notes are borrowed money that a company must repay first if going out of business. Subordinated are those that rank below others on their claim on assets. So we could look at their earning stability, the regulatory environment, potential product liability. The list goes on for looking at the default chance, so the chance of default. And a good way for us to estimate this is using bond ratings. So if we look at bond ratings which are issued by a couple different companies, here we're looking at Moody's and S&P and Fitch. They use different letters to grade their bonds. For S&P here, we see AAA rated. That's the best bond that you can purchase. From there, we're looking at downgrades. So AA, single A, triple B. Those are all still investment grade bonds. Anything below that is a junk bond. So double B, B, and triple C. Moody's, their letters mean the same thing, but they are said different. So the best bond is still AAA, double A, single A. Then we have BAA. So instead of triple B, the name changes to BAA. Means the same thing though. Junk bonds are anything below BAA. But the interesting thing here is looking at their chance of default. So when looking at their chance of default, we see that AAA bonds really have no chance of default within 1 or 5 years. As our bond rating falls, we see that risk increases. So if we're looking at a triple C rated bond, the percent chance of default in 1 year is 22.3%, and within 5 years is 36.9%. And here we see that the yield earned is also greater as our bond rating falls. So the bond spread is the difference between the bond's yield and a treasury security yield of the same maturity. So we're looking at a 10-year bond versus a 10-year treasury security and looking at the difference in their yields. And so here we see a AAA rated bond has a 5.5% yield, which has a 2.82% spread. As our bond rating falls, so as our risk increases, we see that our yields also increase and the spread increases as well because we are being compensated for that risk that we bear. Liquidity premium. Here investors include liquidity premiums when market rates of securities are established. So if the bond will be harder to sell, that will be harder to convert to cash, then it will have a higher liquidity premium. So for example, if we're looking at bonds that are issued by a small unheard of company versus a bond issued by a large well-known company, that smaller company bond is going to be harder to sell than that large well-known companies. Interest rate risk is the risk of decline in bond values because of rising interest rates. This exposure is higher for bonds that have a long maturity or those that are maturing in the near future. The longer the maturity of the bond, the more its price changes in response to changes in interest rates. Reinvestment rate risk. Interest rate risk relates to the value of the bonds, while reinvestment rate risk relates to the income the portfolio produces. So if you hold long-term bonds, then you face a lot of interest rate risk because the value of your bonds will decline if interest rates rise, but you face little reinvestment rate risk. If you hold short-term bonds, then you will face reinvestment risk, but very little interest rate risk. So they kind of work in tandem with one another. So the reinvestment rate risk is the risk of an income decline due to a drop in interest rates. So let's look at an example here to make this clearer. Let's suppose that you just won a $500,000 lottery jackpot. You can invest the money and live off the interest. So if you buy a 1-year bond with a yield to maturity of 10%, then your year one income would be $50,000, which is 10% of that $500,000. At the end of the year, you have that $500,000 still that you can still reinvest. Now let's assume interest rates have fallen to 3%. So instead of having a $50,000 income off of that $500,000, your income has now dropped to $15,000. If you had bought 30-year bonds, your income would have remained constant over the life of this bond. So the yield curve can be broken down into its different risk components. Typically, long-term rates are higher than short-term rates because of the maturity risk premium. And here we see that as we progress, as our time to maturity increases, our maturity risk premium is also increasing, the blue area.